Well, I think I'm being nonpartisan when I say that I don't think there's actually any evidence that the data is driven by any sort of political agenda. And I think the evidence is that the sampling sizes that the Bureau of Labor Statistics has got the resources to reach out to really need to be expanded. But look, we've also had a lot of volatility in policymaking in the past few months, and it's simply hard for the employment numbers, the employment models at the Bureau of Labor Statistics to capture all the volatility. And so I would chalk it up to that. Meanwhile, a lot of other labor market indicators look like, as we were just discussing, we're not talking about layoffs. We're just talking about probably a temporary halt in hiring. And I think as the tariff turmoil abates, we'll see the hiring resume. By the way, there's another issue here, and that is we may also see that these numbers are slowing on the employment gains because we're simply running out of workers. The immigration policies obviously have also had an impact on the labor supply. And as Fed Chair Jerome Powell pointed out last week, there's still a nice equilibrium between demand and supply. They're just about equal, which is why the unemployment rate remains so low. But the supply, the labor supply, labor force has actually been declining somewhat over the past few months.
Yeah, I remember Chair Powell talking about that. So, you know, you're sort of echoing his contention that, look, it's a supply issue. It's not a demand issue. Having said that, though, in the wake of everything that transpired, the firing of the head of the BLS, et cetera, you've got markets now, they've turned tail, right? Before the jobs report came out, we were at about a 30% chance, or just slightly north of that, of the Fed getting back to cuts next month, September. Now we're up north of 80%. Do you think the markets have that wrong?
Well, before I answer that, I just want to interject one other observation here, and that is these downward revisions imply that the productivity numbers are going to be absolutely awesome for the second quarter. We know that second quarter real GDP rose 3%, and now they're revising downwards the labor input, and that means that productivity is going to be very strong in the second quarter, which is a good thing. With regard to the Fed, I've been in the none and done camp since the beginning of the year, and until Friday's number, that looked pretty smart. Now maybe not so much, because suddenly there's about an 80% chance, according to the CME FedWatch model, that there will in fact be a rate cut in September. I'm still resisting that idea because I think we're going to see these tariffs still create some problems in the inflation numbers up ahead here. But I can't dismiss the possibility. I mean, clearly the chances of a rate cut in September have increased. And look, the markets had a heck of a move here, and they were prone to have some profit taking. And I think they had a good excuse for profit taking. But really, what's all the excitement about? Let's say I'm wrong and the economy is actually fundamentally weak, then the Fed will cut interest rates and the stock market will resume its climb.
So, okay, listen, we're 6 weeks, actually, no, about 5.5 weeks away from the next FOMC coming up next month in September. And I'm curious, Adriana Kugler, Governor Kugler, her surprise, even shock, early resignation, right? And I think that takes effect on the 8th, so we're just a couple of days away from that. You know, the president's out to fill that slot. I'm wondering how that is likely to change the shaping of monetary policy at the Fed. What do you think?
Well, I think that we just saw in the latest FOMC meeting that there were two dissenters. Both of them were Trump picks, and both of them, especially Chris Waller, seems to be angling to be the next Fed chair. So both of them have been pushing for declining interest rates, and after the payroll numbers, they can say, "We told you so." And now we're going to have a third person replacing Kugler that'll probably join the dissenters, but maybe they won't be the dissenters anymore. Maybe they'll be the majority if, in fact, other members of the FOMC really respond to these employment numbers by starting to talk about lowering interest rates. But a lot can happen between now and the September meeting, and I'm expecting some inflation news to be somewhat troublesome. I'm expecting that other labor market indicators will continue to look actually remarkably firm. And we may still have a situation where it's not clear that September is a sure thing for a rate cut, because again, the economy may not need it. Once again, 3% is what real GDP was during the second quarter. I know that's history, but these revisions were for history too. They were for May and June.